Talk us through your take on the jobs number this morning.
Well, it was disappointing, of course, the headline number coming in well below anyone's expectation. And what's also, you don't want to get too carried away with one number, but the trend has been slowing, and the weakness was broad-based, and it wasn't easily, attributable to weather or some other special factor. So it was a disappointment, and you had softer wage numbers. So across the board, and coming on the heels of some soft activity data in April, it's not a great signal about the momentum of growth in the economy right now.
Marianne, Mike Santoli has pointed out the fact that we're basically right where we were in January of 2018 on the S&P again. In terms of where you expect to end this year for markets, what is your target?
So our year-end target is 2,900. We do still think that we can have a summer rally up near 3,000. Listen, we've gone from tequila hangover to now the Fed put is still in play. The markets feel like a box of chocolates every day and every week. It feels like something else is in play. With the employment report being a little bit soft in here, and we're expecting the economy, just based on trade tensions, will slow down, but we're not looking for a recession. Lower rates are going to support riskier assets. When you look at the S&P, we recently had the dividend yield around 2%. You had 10-year Treasury yields at 2%. We still find equities better valued than the bond market.
Michael, overall, stepping away just from the jobs number, what's the trend in the data in the U.S. been of late? And where do you stand on how effective rate cuts will be in kickstarting the economy this late in the cycle and with the kind of room the Fed does have to cut?
Right. So right now we're tracking second quarter growth around 1%. That's after around 3% in the first quarter. So first half as an average, we're looking at about 2%, which isn't great, but it's not terrible either. Now, that said, some of the forward-looking indicators like we saw earlier this week, some of the manufacturing surveys in particular, are sending messages that, things may be slowing from here. And then we obviously have the concerns related to trade that has so far been weighing on capital spending. Now, the worry is that that weakness we're seeing in business investment spending may start to morph into weakness in hiring. And then you really have to question the durability of consumer spending, which has really been the locomotive behind this expansion. So that's kind of where we stand right now. We're in a place where business looks more cautious, and we're hoping that doesn't spill into hiring. But this morning doesn't give us a lot of comfort in that regard.
Barbara, it's pretty amazing when you look at what's performed the best sector-wise in the S&P so far this week. It's materials and tech stocks, semiconductor stocks. What do you make of this?
Well, I think, number one, they're basically oversold. And I think that people are looking to put money to work somewhere. They're a little nervous on the big tech and the FANG names because of the overhang regulatory, but I think those will resume. So I really think it's just putting money to work in things where the risk reward has gotten very attractive, not because they're making a call the economy is suddenly going to perk up in a major way.
No, sorry, I was going to say, Marianne, where should people be putting money to work?
So even though we have a softening in the numbers for GDP growth, we're still seeing economic growth. We still like the cyclicals. We still like technology. I would agree semis would be a prime space to start looking. They were great at calling the bottom back in January. I think they're going to be early bottomers. We also like the cyclicals in the area of industrials and consumer discretionary. So even though things from day to day seem to have a lot of volatility, we still think that there's great opportunity within the market.